Next slide, we'll talk a little bit about insurance rates. And what's interesting here is that for the most of my investment career, inputting the insurance premiums and the underwriting into our models to calculate investment returns was really a box check. And it was largely validated by using the same inputs that we had used for 3 to 5 years. Well, due to the increased frequency and severity of weather-related disasters, named storms, so on and so forth, and the rise of replacement costs that we've talked a lot about, insurance were priced in a really violent way in 2022. And it was truly unprecedented in a lot of different markets. So in some coastal markets, this represented a 200 to 300% increase in costs. So this completely blows up pro formas for many owners. And what changing these assumptions on the fly, because a lot of the buyers in the marketplace were getting information that was changing by the week from their insurance providers. This resulted in walkaway decisions for a number of buyers that were proceeding at the closing table. Because these inputs affect all aspects of the pro forma, not just for buyers, but for lenders. So it's impacting valuation and overall operating yields. So this has been a big blow to our marketplace here in the last year to year and a half. And while we think that it's possible that we might see some reprieve from these levels, if you start to see the severity of named storms and weather events starts to decrease and more capital starts to flow into the reinsurance market, and you've got more participants in the marketplace, we might see some reduction here. But at the end of the day, we believe these rates are fairly sticky, and we might not see these 20 to 40% increases that we've seen or in some cases 200 to 300% increases in the coastal markets. We think those days are gone, and we're going to revert more back towards a more typical inflationary increase from here. But we don't see these levels going back down to 2019, 2020 levels.